Welcome to Finance for World. In this explainer, we are focusing on the massive news that has come up in the last 24 hours. We are talking about a tiny window of time that has completely reshaped the global financial landscape. If you've been watching the tickers, you know it's been an absolute wild ride. And today, we're going to unpack exactly what happened and, more importantly, why it matters to your portfolio.
Okay, let's just dive right into it. What we're breaking down today is the chaotic domino effect we've seen sweeping through global markets in just one single day. Across almost all asset classes, from equities to crypto, all the way to commodities, we've witnessed some severe turbulence. It's essentially a perfect storm of macroeconomic factors colliding all at once.
So, what actually kicked off this wild ride? Well, it all starts with two massive macroeconomic catalysts: plunging bond prices and spiking oil.
Now, I want you to think about this number for a second. $111. That's what Brent crude spiked to per barrel. Our sources note this massive surge is primarily due to a lack of initiatives to open the Strait of Hormuz amidst all the ongoing geopolitical tensions. And look, when energy prices jump this sharply, it sends an immediate, highly disruptive shockwave straight through the global economy.
And right alongside that massive oil spike, we got hit with another absolute gut punch. The U.S. 10-year Treasury bond yield hit 4.62%. Think of this yield as financial gravity. It's pulling down high-flying risk assets, because when safer government bonds start offering these higher returns, capital naturally shifts away from riskier investments to lock in those safe, elevated yields.
So, if we pull back and look at the big picture, it's honestly like watching a giant economic puzzle falling into place, but not in a good way. We've got the U.S.-Iran tensions and the Strait of Hormuz pushing up oil. We have rising bond yields in both the U.S. and Japan. All of this creates a gravitational pull, shifting capital straight out of emerging markets and right back into developed economies. And the kicker? Those elevated crude prices could force another round of hikes in petrol and diesel, which is violently fueling global inflation fears all over again.
To put this whole setup into perspective, VK Vijayakumar over at Geojit Investments really hit the nail on the head. He pointed out quite impartially that elevated crude may force another round of price hikes in petrol and diesel, which will undoubtedly have negative implications for inflation. It's a vicious cycle, especially for emerging markets, where currency depreciation and foreign selling just end up feeding right into each other.
With those macro dominoes falling, the immediate casualties were brutal, and they happened fast.
Over in Europe, investors basically slammed the exit buttons. The immediate sell-off was stark. The FTSE 100 dropped by 1.71%. The DAX and CAC 40 both retreated by over 1%, and the broader Stocks 50 fell by more than 1.3%.
But hey, the equities market wasn't the only thing bleeding. Get this, $661 million. That is the jaw-dropping amount of crypto liquidations triggered in the derivatives market in just the past 24 hours, as the whole space faced a sudden, absolutely brutal sell-off.
Major coins absolutely tanked. Bitcoin slipped 2% down to a two-week low of $76,700. Ethereum went down 3% to trade at $2,114. We also saw altcoins like XRP, Solana, and Dogecoin correcting downwards right alongside them as the broader crypto market took a heavy hit.
So, what actually sparked that massive crypto slide? Well, according to the analysts in our sources, it all started when Bitcoin basically hit a brick wall, failing to break through its $82,000 resistance ceiling. Once it got rejected there, and investors started tracking those rising U.S. bond yields and inflation expectations we just talked about, traders started locking in profits real quick, sending the entire digital asset space into a slide.
Now, while most of the world was just seeing red, there was one absolutely fascinating anomaly in the last 24 hours. Let's talk about the wild swings in India.
Talk about a roller coaster. The morning started exactly how you'd expect. The Indian market reacted to global cues with a brutal 1,000-point intraday crash. But then, this massive afternoon turnaround happened out of nowhere. By the closing bell, the BSE Sensex miraculously recovered from the lows to end in the green at 75,315, with the Nifty 50 closing just around 23,650.
How in the world do they pull off that turnaround? Well, the export-oriented sectors essentially swooped in for a massive rescue operation. Tech giants like Tech Mahindra and Infosys in the IT sector, alongside pharma, were the top gainers of the day. They completely offset the heavy losses felt in the media and public sector bank sectors, where stocks like Tata Steel and Power Grid ended the day deep in the red.
But look, it wasn't all sunshine and rainbows there.
Even with that impressive stock recovery, the broader economic pressure was still painfully obvious in the currency markets. The Indian rupee actually slipped to a record all-time low of 96.33 against the US dollar. That kind of currency volatility is a massive weight on overall market sentiment.
The real takeaway here is that the Indian market is caught in some seriously intense crosswinds right now. You've got heavy foreign institutional investor outflows and the India VIX, which is basically the fear gauge, surging 4.5%. Add in the expectations of a U.S. rate hike accelerating capital outflows, and it looks grim. But providing a really vital floor to all this panic are resilient Q4 domestic corporate earnings and favorable valuations. It's a total tug-of-war between external global fears and internal corporate strength.
All right, let's take a breath for a second. If capital is fleeing these risk assets so aggressively across the globe, where exactly is it all going? The contrast over the last 24 hours is literally night and day. We saw this massive dumping of equities and crypto. They were bleeding out. But conversely, we witnessed an immediate sweeping surge into traditional safe havens. The US dollar rallied broadly on that Hormuz Strait uncertainty, and gold saw some really significant domestic gains as people rushed to hedge against inflation.
This flight to safety is super clear when you look at fixed income. The benchmark 10-year U.S. Treasury bond yield advanced by 11 basis points to 4.59% during Friday trading. Global capital is shifting incredibly fast toward developed economy bonds. Why? Because right now they're offering increasingly attractive, much safer returns amidst all this geopolitical chaos.
And of course, we have to talk about gold. Domestic gold rates in India bumped up nearly 0.5% as retail investors sought cover. But there's a staggering 11% price disparity happening right now. In Indian cities, 24K gold is sitting at over 159,000 rupees per 10 grams, while over in Dubai, it's at roughly 143,000 rupees. This really highlights how localized import duties and currency depreciation are actively amplifying the cost of safety in different regions around the world.
We have covered a massive amount of ground in this explainer today, from those intense oil spikes and plunging cryptos, all the way to some miraculous intraday stock recoveries. But as we wrap up, I want to leave you with something to really think about. Is this 24-hour panic merely a temporary blip, just a knee-jerk reaction to the headlines? Or is it the start of a much larger, sustained global market correction? Consider how these massive macroeconomic dominoes we just mapped out might impact your very own portfolio strategies in the days to come. Keep learning, stay focused out there, and I'll catch you in the next one.